Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Meta Platforms today, stock is up 1.5% after Q4 earnings, and the earnings themselves were quite good, I thought. Do note, I own shares of Meta. However, their guidance for Q1 25 was a bit lighter than the market expected, so that explains some of the muted response. On top of that, their guidance for 25 expenses slash CapEx also higher than the market expected. You're probably looking at CapEx slash total expenses that are 20 to 25 billion higher than what they actually spent in 24. So that might put pressure on their bottom line, especially if the top line grows slower than what the market was expecting. However, it's important to note that this stock is up 71% in the past year. Certainly a happy investor because of that. In the past 5 years, stock is up 240%. And then if you look at these dips they had in 22, early 23, if you're a buyer during that period, you're a very happy investor for sure. I certainly added to my position in Meta, and that's why it's one of my top 5-ish positions right now. And I certainly would like to buy more because I love where this company is heading. I love the investments they're making. So let's take a look at the actual earnings themselves. Hard to complain about this earnings release if you're a Meta shareholder. Revenue up 22%, costs well controlled, leading to 700 basis points in margin improvement. EPS up 60%. That is absolutely crazy, really awesome growth. 3.35 billion people on average are using their family of apps daily. That's up 5% year over year. They are already utilizing AI in certain situations. Talked about how it's used for ad targeting, ad impressions up 11%, average price per ad up 10% year over year, leading to really good revenue growth there. TikTok being down or being partially down certainly will help them in Q1 25. So as I look at their guidance for Q1 25, might be a bit sandbaggy. I generally have a feel that Meta has a tendency to be a bit more conservative than aggressive on their guidance, and this may be the case here. Yes, I do expect their margins to shrink, but maybe, just maybe, that'll be an opportunity for shareholders to add to their positions if the stock takes a dip. You saw the dip it took in 22 when their margins started to contract due to some investments, but they can quickly course correct. If they overinvest and it doesn't seem to be paying off, they can cut back on expenditures as they did in 23 and going into 24 and see how their margins expand and how quickly they do so. CapEx in 24, 40 billion. That is going to go up to 60 to 65 billion in 25. They're really investing in AI, data centers, investing in reality labs, their Meta glasses, AI assistants, AI programming tools. AI anything is the name of the game. And if you're in the AI ecosystem, investing in the AI ecosystem, clearly the CapEx guidance from Meta, the CapEx guidance from Microsoft, good news for AI. That's not changing anytime soon. Right now, the monetization of that, there's still a question mark around that, just like there is a question mark around the Reality Labs business that Meta is in. However, the way I see it, you have this really fantastic social media advertising business, and you have the option of potential growth from AI, option of potential growth from Reality Labs that you're buying when you buy Meta. That's how I look at it. When you look at their segment breakout, family of apps growing quite quickly, Reality Labs burning money quite quickly. That's kind of the worry as an investor here. But despite the fact that this business is operating at a massive loss every year, the business overall is still generating very high operating margins. That's because they become so much more efficient on the family of apps segment. They went from a 30% operating margin in Q4 22 to close to a 60% operating margin in Q4 24. That's how quickly they can right the ship, improve margins, and that's what allows them to invest in all of these other things, whether it's AI, improvements on efficiency there from, or Reality Labs, and the potential for the next step forward in computing from that avenue. You know, the way they talk about this, they talk about, hey, we're developing these really powerful AI assistants. That's going to make our other product, our Meta Ray-Ban glasses or our headsets, that much better because you can have this lightweight piece of technology on your head. You can talk to it. You can essentially have a professional level assistant on your head at any time. And maybe, just maybe, the way we moved from computers to phones, from our daily computing devices? Will we eventually move from phones to some of these headsets, some of these eyeglasses? And if so, Meta is certainly in a position to benefit from that. And if not, then you've still got this really fantastic family of apps business that's just getting better with all of the investments they're making in efficiencies in AI. And that is becoming more attractive to consumers with all of the additional offerings that AI can offer them within the Facebook or Instagram or Threads or WhatsApp ecosystem. So as we think about their core business, it's an advertising business. So average price per ad matters. 14% year-over-year change is awesome. These markets outside the US, Europe, Asia Pacific, rest of the world growing at a good clip, becoming a bigger part of the overall business for Meta. That means probably a bit more currency impact on a go-forward basis as rest of the world, Asia Pacific, Europe grow faster than the USA and Canada right now. Average revenue per user is about 14 to 15 bucks. Probably USA and Canada is well above that. A lot of these other markets well below that to an average in the $14 to $15 range. These numbers will grow. These numbers will grow, but grow slower. But it's important that this number continues moving in the positive direction. It's going to be a combination of user growth, combination of ad impressions, and a combination of average price per ad. Eventually, ad impressions, there's only so many you can push onto the consumer. The number of users will continue to grow, but might slow. So it's important that this is efficient, this is growing, that their advertising targeting is fantastic, and maybe, just maybe, AI is starting to help with that because it's certainly moving in the right direction from what this graph shows. As we look at the valuation here, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not an investment advice. Keep that in mind. Meta, a $1.7 trillion enterprise value business, good balance sheet, cash is more than debt. You're talking about a company that generates 50 billion in free cash flow, trading at about a 3% free cash flow yield for a company that's growing at 22% in the last year. Not too crazy in this marketplace. Buying back a ton of shares. These are net buybacks after stock-based compensation. So anywhere from 12 billion to 40 billion after stock-based compensation. $2 dividend per year. I'm bumping that up 10%. I'm using the majority of their free cash flow towards buybacks. 70% of this free cash flow going towards buybacks. If you want to play around with these numbers, hit file, make a copy. There will be a link in the description down below for this sheet. Revenue growth kind of in line with what the analysts have. I may be slightly more conservative here just to pad the numbers a little bit, be a bit more safe on that front. Big drop in margin from 24 to 25 and also into 26. Again, investments in AI, investments in data center, continued investments in reality labs, whether it's the metaverse, glasses, headsets, whatever. I think Meta is the one company that might benefit the most from something like AI because they can embed all of these AI services, AI assistants, whatever, into their various social media platforms. And the goal here isn't to charge you for this stuff because they don't really charge you for anything. The goal here is for you to spend more time on their apps so you can see more ads, so you can click on more ads, so that they can charge more for advertising to advertisers and grow their revenue. So it's more impressions, higher average price per ad, and more people using their apps because they have cool AI stuff in them and it's free outside, unlike some of the other players which might have to start charging for it to make economical sense. And they're also not a hyperscaler. They have their own data centers for their own stuff. They're starting to build their own chips. They're not fully dependent on companies like NVIDIA, so they build their own chips for inference, for training, working with Broadcom to build a new generation chip. They just announced that on the call. So if some of this DeepSeek stuff and new iterations in AI, whether it's DeepSeek or something else, make AI more efficient, make it less compute heavy on both training and inference, that only benefits companies like Facebook, companies that develop their own open source stuff, that develop Llama, and that's going to lead to lower costs, better margins, and potentially higher revenue in the long run. Then you think about AI assistants. How do those benefit their Reality Labs product, whether it's in the metaverse, which kind of they stopped talking about it as much as they used to. Now it's the glasses that they're talking about a lot. The Meta Ray-Ban sold 1 million units in 2024. Not a ton, but certainly a lot of people are looking into those. If there's suddenly an AI assistant on those, does that make it more enticing? So those investments will maybe pay off down the line. But even if not, you're still getting this very healthy social media business that's just getting better with each iteration of AI, which each evolution of AI, and already has 3.3 billion people using it daily. So if you want eyeballs on AI products, you're getting it with Meta. And if you want this thing to become more used, you're probably going to get it with Meta. I mean, certainly a lot of people are using OpenAI. They're using Gemini. I haven't used Meta AI stuff too much because I don't use their products too much, but certainly that many eyeballs, if they can come up with something really cool and interesting, it could flip the switch overnight and make it a really exciting AI product, even if it isn't as much right now. And they already talked about on the call how they have some exciting stuff coming. Remains to be seen what it is, but it'll just be an additive thing to the great business they already have in my mind. When you look at these revenue growth assumptions, when you look at these free cash flow margins assumptions, investment cycle in 25 and 26, getting back to more mature margins in 27, 28 and 29, using a lot of that money towards buybacks, still about 70 billion in excess free cash flow beyond that, so it can raise the dividend more, do more buybacks, do some M&A. This is a administration that's going to be a lot more open to M&A. If Meta wants to acquire something big, they probably can under this administration, whereas they couldn't under the old administration. So plenty of flexibility here. And when you look at the valuation the market is giving this, I have it here at a 3.5% free cash flow yield in the future. Seems relatively fair for a company still growing in the low teens to high single digits for the next couple of years, with margins that are expanding, with interesting products in the pipeline that aren't really earning any money right now, but might in the future. You get a fair value of $682, which is right where it's trading at right now, with a target return of about 10%. So you're looking at about a 10% return after buybacks, after dividends at 687. That's not too bad. Seems to me like it's something that if you're looking at buying it today, you're not getting a terrible deal. If you want to be a bit more conservative, put it at a 4% free cash flow yield, you get a fair value of 591. If you want to be a bit more aggressive, put in a 3% free cash flow yield because you don't think the market's pricing in any upside from AI or Reality Labs, you get a 773 fair value. Either way, you're looking at a price in that like $950 to $1,200 range a couple of years down the line. So this is definitely heading to $1,000 eventually. This is a business that's healthy, that's relatively safe, that's continuing to generate a bunch of free cash flow that they can invest in easily. They can buy back shares. They're working on other stuff, and none of that other stuff is really embedded within this assumption. Like, I don't think they need to do anything with Reality Labs to hit these revenue growth targets. They maybe need a little bit of AI improvement on the bottom line and improvement on the AI targeted side to hit these free cash flow numbers and these revenue growth numbers. But at the end of the day, if AI becomes a huge thing for them, this stock could grow much faster than this. If Reality Labs suddenly starts taking off, this stock could grow much faster than this. I think this is a company that is one I want to be invested in. It's one I am invested in. Would I buy more today? Probably not. I feel like I have a healthy enough position. It's one of my biggest holdings already. But if the stock suddenly, takes a little bit of a dip, drops into the 590s, like I'm showing here, would I buy more? For sure. Just, a 10% margin of safety from today gets you to 614. Seems like a very healthy buy point. Again, the market could negatively react to another year of margin compression, even though they've already said, hey, our margin is going to compress, we're spending more. Get used to it. Once the market actually sees it, who knows what the reaction will be. They'll say, wow, it's 2022 all over again. Their margins are compressing. The end of the world is happening. The stock is going to drop a bunch. And if it does, I'll just be there to buy a bunch more, because I think this is a company that has a lot of potential. And even if that potential ends up being nothing, even if Reality Labs ends up being nothing, which I don't think it will be, even if AI ends up being not much, which I don't think it will be, they still have this very healthy business, and that's mainly what you're pricing in right now. If Reality Labs just stopped being an investment today, they'd get an additional $15 billion in free cash flow. So one may look at that and say, why are they wasting that much money when they could just be buying back shares or issuing a bigger dividend or acquiring another company or something like that? But you can also look at it another way. I think the way Mark Zuckerberg looks at it, it's that, hey, if we do something really cool, this could become on its own a tens of billions of dollar business somewhere down the line and start generating profit and start being a major contributor to this business into the latter part of this decade, into the next decade. And if that's the case, then this stock is well underpriced for the promise that something like that might bring. Same with AI. What if AI brings massive efficiencies to this business, and suddenly this is a 40% free cash flow margin business a couple of years down the line? It's already generating a ton of free cash flow. it could do a lot more. So that's something you have to keep in mind as an investor. There's potential upside here that I don't think is being priced by the market that you could take advantage of if it plays out. And if it doesn't, you still have a company that's growing at a healthy clip, that has healthy margins, that is buying back shares, issuing a dividend, and has the dry powder to do whatever. They could make an M&A acquisition. They could go into adjacent businesses. What if they want to get into streaming and they say, hey, we're going to go out there and we're going to acquire Warner Brothers Discovery. We're going to spin off the TV channels. We don't want those, but we're going to keep the studio. We're going to keep the streaming service because we want content. We want to be a content advertising machine, and that's one way to do it. What if they acquire Roku? What if they do whatever? This is an administration that's going to be healthier for businesses, at least, than the other one was. It's going to be healthier for an M&A, from an M&A standpoint, and that can benefit a company like Meta. So we'll see what they do, but for now, I'm very happy holding these shares. If there's a price dip that's 10 to 15% below where we are today, I would build my position for sure. But right now, it feels reasonably priced, healthily priced even at a 3.1% free cash flow yield. Remember though, if there is a recession, advertising will get hit. This stock will drop for sure. To me, that is an opportunity to buy. Whenever Meta is on sale off of this fair value number, a long-term fair value number, to me, that's an opportunity to buy, and I will continue doing so until I see otherwise. And this earnings just made that more clear to me than it was before. So let me know what you think down below. Do you like Meta? Do you hate it? Are you a holder, a buyer, a seller? Leave a comment. As always, like, subscribe, all of that good stuff. Thanks for watching, and bye.